Well, it's a brand new year, but the S&P 500, well, let's just say it hasn't exactly been off to the races, right?
Not quite the start we might have hoped for, right?
Yeah, down roughly 5% already as we kick off April. And, when the market takes a little dip like that, it always gets the gears turning right. It
Mhm.
makes you wonder, where are those hidden gems? Where are those potential opportunities lurking?
Absolutely. Those times can be full of, well, possibilities. But the thing is, we often see a lot of focus on the overall market trends, or maybe those companies that were soaring high and have recently, taken a bit of a tumble.
Right, exactly. But today, we're going to flip the script a little bit. We're diving deep into the three worst performing stocks within the S&P 500 as of Monday, April 1st, 2025. Now, I know what you might be thinking. Why on earth would we focus on the losers?
Yeah, it might seem a little counterintuitive, right?
It might, but trust me, there's a method to our madness. For this deep dive, we're using a Motley Fool article, and they've done a really interesting analysis of these underperformers. And get this, the three companies in question are Deckers Outdoor, ticker symbol DEC. They've taken a pretty substantial hit, down 46% year to date. Then there's the one and only Tesla, TSLA, down 38%, which, always makes headlines. And last but not least, On Semiconductor, ticker RNN, which has slipped by 36%. So we're talking about some serious drops here.
Oh, absolutely. We're not talking about just a little blip on the radar. To give everyone some perspective, a 5% dip in the entire S&P 500, that's something to pay attention to. But we're talking about individual stocks that have plummeted almost 10 times that amount, and all this in just a few short months. So naturally, it makes you wonder, are these companies dealing with some fundamental issues, or could these dramatic declines actually be, a chance to snag some potentially undervalued assets? Of course, that's if you're the type of investor who's not afraid of a little or maybe a lot of risk.
Exactly. And that's precisely what we're aiming to uncover today. We're going to dissect each of these companies, really look under the hood using this Motley Fool analysis as our guide. We want to grasp why they've had such a rough start to the year and see if this article gives us any hints about a possible turnaround. Or, on the flip side, if there are still too many red flags waving at us to even consider them. All right, let's kick things off with the stock that's taken the biggest hit so far this year, Deckers Outdoor. Buckle up, because this is where things get a little, a little interesting.
The thing that really jumps out at you with Deckers is this kind of, contradiction. Despite being the worst performing S&P 500 stock so far, down a whopping 46%, they actually posted some pretty solid results for the last quarter of 2024. We're talking a 17% surge in revenue, with net sales hitting $1.8 billion. So on the surface, those numbers don't exactly scream, hey, we're in trouble.
Right, you see those numbers and you're like, hold on a second, what's the deal here? So what's going on? Well, the Motley Fool article highlights this interesting point. Even though Deckers is projecting a healthy, a very respectable 15% growth in their top line. And just to clarify for anyone listening, top line simply means their total revenue for the year. It seems like analysts weren't entirely blown away by the specific guidance the company offered. So it's a good reminder for all of us out there, a company's past performance, even when it's strong, doesn't guarantee smooth sailing for their stock, especially when those market expectations are sky high.
Yeah, that really underscores how much market sentiment, those overall feelings and expectations, can impact a stock. Think about it. A company can have a stellar quarter, knock it out of the park, but if their future projections don't quite match the rosy picture that investors have, well, that can trigger a correction, sometimes a pretty significant one. And the article brings up another key factor that probably played a role in Deckers' decline.
Yeah, and they point out that Deckers was trading at a pretty, let's call it a premium valuation, over 35 times its trailing earnings. Now, just to break that down a little, trailing earnings basically refers to the company's profits over the past 12 months. And that multiple, that 35 times, it gives you an idea of how expensive a stock is compared to its actual recent profits. And when you're dealing with, let's face it, a somewhat shaky economic climate, a price tag like that can make a stock seem pretty risky. Investors might be thinking, okay, time to cash in some chips, or maybe I should shift gears and look at companies that seem a bit more, reasonably priced.
Right. It makes sense. So it looks like a mix of things might be at play here. The guidance that maybe didn't quite wow analysts, that high valuation it was sporting, these likely all contributed to the stock's, rather steep drop. But the article does mention that the valuation has come down quite a bit lately.
Oh, yeah, definitely. Deckers is now trading at around 18 times its trailing earnings, which is a pretty noticeable difference. But the Motley Fool even suggests that it's a cheaper stock to own now. So for those of you who are value-oriented investors, that might pique your interest, right? It might seem like a good entry point. However, the analyst they quote in this piece throws in a little word of caution.
And it's a crucial point. Is a lower valuation alone a green light to buy? Is it a good enough reason? The article leans towards holding off for now, mainly because, as they put it, the economic ground is a bit shaky. They specifically mention some potential headwinds like trade wars and tariffs, which could definitely have an impact on a global business like Deckers. And then there's also the possibility that they might have to adjust their future earnings projections, lower them a bit if the economy doesn't pick up steam.
Yeah, so it's kind of a mixed bag. Deckers has shown some good stuff in the recent past. But those future uncertainties, combined with, the overall economic jitters, they seem to be weighing down the stock price. It's a good lesson for all of us, right? Investing is about looking ahead, not just at what's already in the rearview mirror. Okay, let's shift gears to our second underperformer, Tesla.
No.
This is one company that never seems to shy away from the spotlight, good or bad.
Oh, that's for sure. And when it comes to Tesla and that 38% year-to-date slide, the article points to a few key factors. One of the main things they highlight is, questionable growth prospects.
Yeah.
It seems like that rapid, almost breakneck growth that investors have been used to seeing from Tesla might be viewed with a little more skepticism these days.
Yeah, and they bring up this really fascinating and somewhat unique factor, which is the relationship between CEO Elon Musk and former President Donald Trump, and the impact of some of those government policy shifts that Musk has reportedly been, behind. And this has apparently created some friction with consumers and analysts. There have even been reports of protests at Tesla dealerships, which is pretty wild. It's a good reminder that sometimes those non-financial factors, those public perceptions and opinions, they can definitely move the needle on a company's stock performance.
You hit the nail on the head there. It's not always just about the numbers. While a deep dive into the financials is essential, understanding the bigger picture, those political and social currents swirling around, it can really help you grasp what's truly driving a stock. And, when we zoom out a bit, negative public perception, that can impact car sales, brand loyalty, the whole 9 yards. And the article doesn't shy away from outlining some of those financial hurdles that Tesla's currently facing.
Yeah, and the numbers they lay out paint a pretty clear picture. Tesla's revenue from its automotive business actually dropped by 8% in the last quarter of 2024, ending up at $19.8 billion. But here's the kicker. The drop in profits, this is where it gets eye-catching, a massive 71% year-over-year decline down to $2.3 billion.
Those kinds of figures, let's just say they don't exactly inspire a ton of confidence.
Nope, not really. A steep decline in profitability, that raises some serious questions about a company's ability to keep those earnings rolling in. And when you combine that with the uncertainty surrounding future growth, it creates a pretty challenging narrative for investors to buy into. And from what I gathered, the Motley Fool piece doesn't paint a super optimistic near-term picture for Tesla. Yeah, no sugarcoating here. The article states pretty bluntly that things look to be going from bad to worse for Tesla, which is a pretty bold statement. So even with that substantial drop in the stock price, they still seem to think there's a chance it could fall even further.
And a big reason for that continued caution is the valuation. Even after that 38% drop, Tesla is still trading at over 90 times its estimated future earnings. The article really hammers home the point that this makes it a highly expensive stock to buy and suggests that it has a lot more room to fall.
That's a huge takeaway here. Just because a stock's prices drop significantly, it doesn't automatically mean it's a bargain, right? If the underlying business, those core fundamentals, are showing cracks and the future looks uncertain, even a seemingly lower price can still carry a lot of risk, especially that valuation is still stretched. Okay, ready to move on to our final company for this deep dive? Let's talk about On Semiconductor.
Now, On Semiconductor, or On Semi as they often go by, has seen a 36% decline year to date. A really important thing to understand about their business is their close ties to the automotive industry. The bulk of their revenue, the lion's share, comes from this sector. So you can see how their performance might be influenced by some of those same broader forces impacting Tesla and the EV market, those electric vehicles.
Yeah, that makes sense. And the article explicitly mentions that On Semi is vulnerable to those same economic headwinds we talked about, like tariffs. Those taxes on imported goods. Remember, we discussed those with Deckers. Well, they're affecting EV manufacturers too. And this whole interconnectedness within the automotive supply chain, that's definitely something to keep in mind. And On Semi's recent financial results, they kind of reflect these challenges as well.
Exactly. Their 2024 numbers showed a 14% year-over-year dip in sales, which landed at $7.1 billion. This really highlights those headwinds they're facing in the auto sector and just the overall, macroeconomic landscape. The article echoes a sentiment we saw with the other two stocks, suggesting that a quick turnaround, a sudden rebound, that's probably not in the cards right now given the current economic climate.
But there's a little twist here, a different angle when it comes to On Semi's valuation. They point out that the stock is trading at a relatively, well, let's say modest 16 times its estimated earnings for the coming year. And this leads them to suggest that it could be, and I emphasize could, the best buy on this list. But, and this is a pretty big but.
Yeah, there's a catch, a condition attached to that potential best buy title. The article stresses that it all hinges on investors being willing to exercise patience with the business. They're not painting this as a get-rich-quick scheme or a stock that's going to bounce back overnight.
Exactly. That's a really crucial point for all of us to grasp. If you're looking for a quick return, a fast buck on Semi, well, based on this analysis, it might not be the right fit for you at this moment. However, the article does highlight some potential long-term factors that could drive growth for the company down the road.
And what's encouraging, at least from a long-term perspective, is the emphasis on significant opportunities for semiconductor companies, not just within the automotive world, which, is becoming more and more tech-heavy, but in other industries as well. So the implication is that even though there are challenges right now, the demand for semiconductors, those tiny but mighty chips, that could provide a pretty strong tailwind in the years to come.
Oh, and one more interesting tidbit. They mentioned that On Semi stock is currently trading at multi-year lows, like levels it hasn't seen since back in 2021. So that historical context, that might make it a bit more appealing to those value-focused investors. But again, the key message here is patience.
Absolutely. That lower trading price, coupled with the potential for that long-term growth in the semiconductor space, it presents a different kind of risk-reward scenario compared to, say, Duckers or Tesla, at least based on this particular analysis we've been dissecting today.
Okay, so let's try to wrap all of this up in a nice little bow for you. We've looked at 3 companies that have landed themselves at the bottom of the S&P 500 barrel so far this year, but each for different reasons. Deckers, well, they've had some decent recent performance, but those future projections and the looming economic uncertainties are creating some doubts, especially when you consider that high valuation it was carrying before. Tesla, on the other hand, they're battling questions about their growth trajectory, a pretty dramatic drop in profits, and some negative sentiment tied to their leadership, all while still trading at a very, very high multiple. And then we have On Semiconductor, facing those current headwinds and those broader economic pressures, but with a more reasonable valuation and the potential for long-term growth if, and that's a big if, investors are willing to play the waiting game.
And it's super important to remember that this is just a glimpse, a snapshot in time, one perspective from a single article published in early April 2025. The market, well, it's a dynamic beast. It's constantly in flux. And doing your own homework, conducting your own thorough research, that's always a crucial step before making any investment moves.
Could not agree more. So here's a little something to ponder, something to chew on. Looking at these contrasting scenarios we've explored, which, if any, aligns with your personal investment philosophy. And how much risk are you comfortable shouldering? And what other digging, what other research would you do to form your own well-informed opinion about these 3 companies? Because that's where the real magic happens, in the work you put in. Thanks for joining us for this deep dive. We'll see you next time.
Until then.
Bye.